Hello everyone, welcome to Just Invest Today. And in today's video, we are talking about Alibaba and actually Charlie Munger doubling down, tripling down. And is this a wrong decision? Is this a bad decision? Because people on Twitter are still killing Charlie Munger for his decision. Everyone that followed him are idiots. They're all wrong for doing what he's doing, blah, 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 right? So we're going to do a checklist, a quick checklist on averaging down. I'm actually going to be talking about an article that Bill Brewster actually posted from the Acquirers Multiple podcast, and he talked about averaging down, and sometimes it could be a very bad thing. Averaging down has destroyed a lot of value investors because, guys, if you buy it at 40 and you're wrong at 40, and then you go to 20, and then you're wrong at 20, then you go to 17, you're just doubling down on your loss, not just taking it on the chin and just going about your business saying, okay, this is wrong, and you just sell it off and you move to the next company, which is way safer because people religiously just look at Warren Buffett and be like, okay, if you love the company at 20, that means you would like it at 15, right? It should be that simple. But what if you're doing the wrong thing? So let's go over a quick checklist on Alibaba, see if Charlie Munger is wrong, see if I'm wrong, see if a lot of value investors are wrong about this purchase of Alibaba. Because, man, in this market, we are not surviving the brutal apocalypse of Alibaba. 307, man. That was at its peak in 2020. Can we get back to that peak one day? Who knows? But 72% down, it's at $86. And I still gotta go back to it because I got so much hate for this. Posted this video a month ago, 1 month ago, saying Alibaba to $80. Guess what? I got so much hate for this video. And look where Alibaba is at right now. Freaking $86, and that's probably gonna go down to 70 very soon. Like, I wouldn't doubt it, especially with the Ukraine war going on. Who knows what's gonna happen with all that? It can turn out crazy. So before we get into this video, guys, please like this video, subscribe to my channel. I'm providing you guys with so much new content all the time. So, man, like it and subscribe, man. Click that subscribe button right now. So let's get into this article. Bronte Capital. So this article is about when do you average down. This is key because a lot of people just average down because you think it's appropriate just to average down because you bought the company at 40 and now you need to average down to 20. But man, that can be very wrong. And in this article, it talks about Bill Miller actually blowing up for doing the wrong things. Then Warren Buffett actually did a good thing of not averaging down when he actually invested in an Irish bank that exploded. I think it went bankrupt, and he didn't average down. So you see the two differences, and we see Warren Buffett averaging down on a lot of good, strong companies, and that's when he averages down. So Warren Buffett is famously fond of averaging down. If you liked it at 10, you should love it at 6. If it goes down, just buy more. But averaging down has been the destroyer of many value investors. Indeed, averaging down is the iconic way in which value investors destroy themselves. So are we destroying ourselves by averaging down? After all, if you love something at 40, you were wrong. You might love it more at 25, and you almost as likely to be wrong. And like it more still at 12, you could equally be wrong. And before you know it, you could have doubled down 3 damn times, turning a 7% position into an 18% loss. So just look at what happens when you keep doubling down and you're wrong. You're just making yourself more incorrect. So when do you look at things? When do you see the truth? And when do you kind of reevaluate your position to see if I'm doubling down successfully? So when are you wrong when you're averaging down? Because honestly, at the time you're investing, when the market goes down and when you're averaging down on a company, you don't think you're wrong. You think you're right because you wouldn't have bought into the company and you wouldn't be averaging down. So when is it not safe to average down? And he gives you 2 prime examples of Warren Buffett and Bill Miller and what they did. Warren Buffett, he bought $500 million worth of Irish banks as they collapsed. They went approximately to 0, but he did not double down. He liked them down at 90%, but he did not like them down 95%. By contrast, and that's what you're going to do, you're not investing in these high leverage businesses, especially when they're going bankrupt or a potential to go bankrupt. Phil Town likes to actually buy businesses where you can actually pay off all the long-term debt with at least 3 years of free cash flow. So that's what I look for. At least 3 years of cash flow, the business is able to pay off its debt because, man, in this market today with inflation, with interest rates potentially going up, you do not want to have a business with a lot of debt or not producing cash flow to pay it off, because then they have to keep kind of putting out equity or getting more bonds or just getting more money from the government, from the market, wherever they're getting their money from. And then on the contrast, look at Bill Miller. Bill Miller blew up on American International Group, Wachova, Washington Mutual, Freddie Mac, Countryside Financial, and Citigroup. They were all leveraged business models. By contrast, you can probably safely average down on Coca-Cola. Indeed, Buffett did. It is really hard to work out realistically circumstance in which Coca-Cola is a zero. That's important. Like, you can't imagine Coca-Cola going to zero. Can you imagine Baba going to zero as being the number one e-commerce company? Like, it's just very hard. And if it's still growing, there is going to be a price at which you are right. So the business is still growing on top of it going down. So averaging down is going to go some way to obtaining an average cost near below that price. Of course, even Coca-Cola is not entirely safe. So that's the thing. Coca-Cola is not going to be entirely safe, because what if they found out that Coca-Cola actually gives you cancer, and then they have a lot of lawsuits, and then it may be bankrupt? You always have these black swan events that come up. So the black swan event for Baba that can come up could be the government takes it private, or China invades Taiwan and then no one likes Baba anymore, or something crazy, some situation like that can happen that might take Baba out of favor or maybe go to zero. So black swan events can happen because no stock is just unsafe. But what are the chances of that happening? If it's not likely, then you can double down on your positions. So make sure the businesses that you're levered on, or the businesses that you're buying, are just not highly levered. They don't have a crazy amount of debt, because paying it off is going to be very important, especially when the interest rates are rising and they're going up. Another reason not to double down: obsolescence. There is another iconic way that value investors lose money, and that is the technical obsolescence. Kodak was made obsolete and was a value stock all the way down to bankruptcy. The circumstances on which you might be wrong, digital photography going to 95% of the market, could have been stated pretty clearly in 1999. You might think it was worth owning Kodak as a cigar butt stock, plenty of cash flow, and deal with the future later. There was a reasonable buy case for Kodak the whole way down. But technical obsolescence is always a way you should be wrong. When the threat is obsolescence, you are not allowed to average down. And that is huge. That is so huge, because people thought Kodak was going to be this amazing photography company. It's going to last forever. But they didn't think about another product coming to market and taking that over, taking that mind share that the product is not the best, that there's another competitor coming through. So do we believe Alibaba is going to be obsolete very soon in the future, 5-10 years from now? Like, what's the likelihood of competitors just blowing Alibaba out the water, just killing it? Like, I find that highly unlikely, because like Alibaba's moat is just so damn strong that I just don't see it just getting killed. But who knows? It's a possibility, but technically I just don't see that. So that's another reason why you don't double down. If there are competitors coming up, competitors in the space that might just take its food, just eat its lunch. So that's a reason not to double down if you don't understand the future of the product, of the company. And lastly, this article talks about fraud, and it gives a good example of Bill Ackman investing in Valiant when it was going down and it had junk bond debt. So the business is highly levered with a potential to have fraud or fraud in the business. Then you kind of you want to avoid it. You don't want to average down when people are speculating about fraud in the company. I wouldn't average down, even though it might be wrong, it might not be untrue. I wouldn't play that game. It's just too much for me to play that game if the business is highly levered, plus there's fraud speculation. And Bill Ackman doubled down on Valiant and got killed in the market for doing that. I know a lot of people are saying Alibaba is a fraud, they're hiking up their numbers, their revenue, blah blah blah. They say all of that. So they're just trying to say, yeah, Alibaba is like a valuant, but really, do we really think Alibaba is doing it? Think about it. This is the biggest company in China, one of the biggest companies in China. You think they need fraud? Like, think about it. Like, everyone in China basically uses Alibaba. Why would they need to improve their balance sheet or improve their revenue or free cash flow? Like, it's just unheard of. It's like saying, oh, Amazon has fraud or Apple has fraud. The biggest company, maybe if it was a smaller company that's actually not being kind of regulated, top brand names actually auditing their accounting, then maybe you can say Alibaba is a fraud, but that is not true. They have the top brand auditing their financials, man, and they're the biggest company. The one biggest company in China is going to be the fraud out of all the small ones. Very, very, very unlikely. So I don't even see that as a risk. To sum it up all for you guys, number one, if the business is highly levered, it has a lot of debt, and it's not able to produce enough cash to actually pay it off in 3 years, don't buy it, man. You got to make sure these business actually produce cash, because the cash is going to be able to pay off the debt in case of any financial turmoil or any down markets and any interest rate hikes or inflation. So it's important not to invest in these businesses that are highly levered and they're not producing enough cash to kind of pay that off. Number two, you always have to make sure that it can beat out its competitors, and the business model, the products are not going to be obsolete in 4 to 5 years. That has to be key, because when you're a profitable business making a lot of money, there's always going to be competitors looking out how much profit you're making and trying to take you down and nibble at your profits and not your revenue and not your income and all of that. So important to have a moat. So important for the business to be simple, so you can predict in the future 5 to 10 years with some kind of certainty that the product, that the business is going to be there. For example, like chewing gum won't go away. You know that business is going to be there 5-10 years down the road, and it's going to be strong if it has a brand name. Lastly, fraud, man. If the business has any semblance of fraud, do not go into it. Plus, with a lot of debt and fraud, no, just avoid it, man. So those are the 3 things or 4 things to avoid. Guys, please like and subscribe to my channel. I'll get back to you in the next video.